Hey there, and welcome to This Explainer. Today, we are going to completely demystify financial success. For decades, we've all been sold this massive myth, the idea that building wealth requires raw, calculating intelligence, a genius level IQ, or, some fancy Ivy League degree. But what if I told you that your financial future actually relies entirely on your psychological discipline and not on your IQ at all? Well, today, we're unpacking exactly why that is.
It's a question that really shatters everything we think we know about money. Why do some of the absolute smartest people in the world end up blowing up their portfolios and losing it all? Seriously, why do folks who barely know the technical side of finance sometimes build substantially more wealth than the so-called experts? We all know highly educated professionals who've made absolutely terrible financial decisions, right alongside ordinary everyday folks who have quietly built these incredible fortunes. To understand why this happens, we need to completely shift our perspective.
And this brilliantly illustrates the core issue. We just naturally assume finance is pure mathematics. We picture spreadsheets, complex formulas, and perfectly rational calculations. But the reality? Finance is psychology. Money is not just math. Money is fundamentally about human behavior. History tells us a very, very clear story here. The deciding factor between financial success and massive failure is almost always how you behave, not how smart you are. Let's ground this in a real, relatable scenario. I want you to put yourself in this story for a second. Imagine two investors. They are starting on the exact same footing. Both have the exact same amount of money to their name. Both have access to the exact same information on their computer screens. Both completely understand how the stock market works. But then, a market crash happens. The charts take a massive dive. The screens flash red. Financial panic sets in across the globe.
Here is where their paths diverge, and spoiler alert, it has absolutely nothing to do with intellect. The first investor panics. He sees those red numbers everywhere and immediately sells everything just to stop the bleeding. The second investor? He stays totally calm. He understands that market declines are just part of the process, and he keeps consistently investing. 10 years later, that second investor is vastly wealthier. The data was identical for both of them, the psychology was different. Ultimately, financial success is way less about what you know and far more about how you behave when emotions try to take the wheel. Okay, let's dive into this. The very first emotion that tends to hijack our brains is fear. When economic uncertainty hits, fear becomes this paralyzing force. People become so overly cautious that they just stop investing entirely. They sell off their assets, they hoard cash, and just let it sit there, completely idle. Now, sure, a little bit of caution can sometimes be useful, but this kind of excessive, paralyzing panic actually causes people to miss out on massive, life-changing opportunities. Just think back to the 2008 financial crisis as a vivid historical anchor for this. Stock markets around the entire world just collapsed. Millions of people, acting purely out of fear, sold their investments because they were absolutely certain things would only get worse. But the outcome was undeniable. Those who panicked locked in massive losses permanently. They literally destroyed their wealth. Meanwhile, those who managed to stay calm and stay invested, they saw the markets eventually recover and go on to reach unprecedented new highs. But fear is really only one side of the psychological coin. The exact opposite extreme is greed, and specifically the modern engine of greed, FOMO, or the fear of missing out. You see your neighbors, your friends, random people online making a killing, and you feel this powerful, visceral reaction that you are being left behind. Suddenly, you're just throwing money around without doing any research at all. You ignore all the obvious red flags purely because you've convinced yourself that prices can only ever go up. Just look at the dot-com bubble. In the late 90s, investors were rushing into literally any internet company they could find, completely ignoring whether those businesses actually made a single dime of profit. By 1999, stock prices were absolutely soaring. Everyone wanted in on the action. It was a complete and total frenzy. But then, in the year 2000, reality finally arrived. The bubble burst. And by 2001, countless companies completely vanished, and investors lost billions of dollars. Why? Because the frenzy of greed had entirely replaced rational thinking. All right, let's take a collective breath here and slow down for a second. We've talked about the dramatic, noisy extremes of fear and greed. But the real ultimate superpower of wealth creation is incredibly quiet. It's patience. Our modern society is entirely wired to reward instant gratification. We want results immediately. We want wealth quickly. We want the trappings of success without actually having to wait for them. Unfortunately for our modern brands, true wealth creation rarely works that way.
Most real fortunes are built incredibly slowly. To really grasp this, think about that classic psychological analogy. Imagine a child is offered a choice. Get one piece of candy right now, or wait a little bit and get two pieces of candy later. Many kids, naturally, lunge for the immediate reward. And honestly, a lot of us adults would still struggle with the candy today. But we do the exact same thing with our money. We spend today instead of investing for tomorrow. We prioritize short-term pleasure over long-term benefits. The ability to delay gratification is actually one of the absolute strongest predictors of your financial success. So the crucial point is time, specifically a horizon of about 20 years. Time and consistency. A person who invests a small, manageable amount consistently over 2 decades almost always beats the person frantically chasing the latest hot trend. The secret to long-term wealth isn't achieving extraordinary, lightning-fast returns. The secret is just consistency. Now, right now, you might actually be sitting there thinking, well, I wouldn't make those mistakes. I know better. And honestly, that brings us to the ultimate ego trap. Many financial disasters don't happen because people lack information. They happen because people suffer from an overconfidence illusion. They honestly believe they can magically avoid mistakes, and that financial risks only apply to other people. This belief that you are somehow different from everyone else is an extremely expensive illusion. Let's move to and see how this builds, because truly successful investors completely avoid this trap by understanding their own limitations. They acknowledge the hard reality that absolutely nobody has a crystal ball. So instead of trying to predict the future perfectly, they shift their entire focus to managing risk. Recognizing that you cannot predict the future isn't a weakness. It's a brilliant, highly effective form of risk management. So what does this all mean for you? How do you actually apply this to your own life? Here is how you win the mental game. 1. Control your emotions before making any financial decision. 2. Actively avoid making choices based on extreme fear or extreme excitement. 3. Force yourself to think long-term. 4. Focus on quiet, steady consistency rather than chasing quick profits. And 5. Always recognize that building wealth is fundamentally a psychological challenge, not just a mathematical one. Let's bring this all together. And honestly, this should be an incredibly comforting and empowering realization for you. You do not need a Wall Street pedigree to win. Everyday people can do this. The people who win financially are not always the smartest people in the room. In fact, they rarely are. They are simply the most disciplined. Because in the world of money, your daily, grounded behavior matters so much more than your raw intellect. I want to leave you with this final, really vital thought. As you look at your own financial goals, your own habits, and your own future, ask yourself honestly, are you investing with your intellect or your emotions?